Thanks everyone for joining us today. I'm Megan Neenan. I'm a managing director and the North America head of non-bank financial institutions at Fitch. So joining us today for the direct lending panel is Caitlin Howard, who's the head of BDC unsecured funding at Blue Owl Capital, and Seth Meyer, who's CFO and chief accounting officer at Hercules Capital Inc. So BDCs have had a lot of attention lately, so we're happy to have these two great folks here joining us today to hit on some of the hot topics that we've been hearing about. So Seth, I'm going to start with you. Let's kick off with one of the hottest topics in the sector today, which is software. So in your firm's own words, Hercules' portfolio is largely comprised of innovative, tech-oriented businesses that embrace technology with an entrepreneurial mindset. So more specifically, at year-end, 24.3% of the portfolio was composed of investments in application software, and 10.6% was in system software. So can you talk a little bit about how Hercules thinks about the evolution of AI and its potential impact on the performance of the portfolio?
Sure, Megan, thanks. First, I want to point out that we don't lend into AI or data center infrastructure directly. That deliberate positioning keeps us out of the highest velocity, highest risk management, risk segments, pure play AI GPU build outs, while still letting our portfolio companies capture operating efficiencies as the ecosystem matures. We believe AI is a net positive for the majority of our portfolio, reminding everyone that it is both tech and life sciences that I'm speaking about. Our borrowers are largely innovative, tech-forward companies, as you outlined. Many are actively differentiating themselves from legacy software competitors by integrating general and agentic AI into their products. They are usually the disruptors, not the disrupted. Additionally, our software exposure cannot be broadly bucketed into AI obsolescent risk. It spans cybersecurity, defense tech, regulatory tech, and domain-specific platforms, which are not interchangeable with SaaS business.
Great, thank you. And Caitlin, over to you. The Blue Owl BDCs have varying degrees of exposure to software. So 70% at the Blue Owl Tech Finance Corp BDC, and then 11.1%, for example, in internet software and services at Blue Owl Capital Corporation. So many BDCs in the last kind of earnings calls discussed above average revenue and EBITDA growth for software investments compared to the portfolio more broadly. LTVs like pretty attractive, below 40% generally. So those statistics are certainly encouraging, but there's lots of naysayers kind of downplaying the significance of the meaningful equity cushion in the software portfolio. And they're kind of pointing to a bit more of a binary outcome for some of these investments. So can you discuss why that's not the case here and why sponsor equity is an important consideration?
Yeah, thanks, Megan. It's a totally fair question and one we spend a lot of time on internally. To start, let me just level set by saying that we've always liked software. It's been a significant contributor to our performance. We built dedicated technology investing capabilities to match the opportunity set, and our portfolio performance remains excellent. Our software borrowers are delivering low to mid-teens revenue and EBITDA growth on average, which is among the strongest across our direct lending strategy. As a reminder as well, we are lending to upper middle market, very scaled businesses in software in particular, with a weighted average EBITDA of 300 million and revenues in excess of $1.25 billion. While software business outcomes can appear binary at first glance, especially for those buying into the recent AI hysteria, our experience has been very different. The key reason is the depth and the durability of the sponsor equity in these capital structures. So in our technology book, LTVs are typically in the mid to low 30%, and there's a meaningful capital subordinated to us that absorbs volatility long before credit impairment becomes an issue. We have a substantial buffer even in periods when equity valuations are pressured, which helps support downside protection and durable earnings. And importantly, sponsor equity in our software portfolio isn't just financial, it's operationally engaged equity. So sponsors are actively managing pricing, cost structures, go-to-market strategy, M&A opportunities, particularly as AI is reshaping end markets. So rather than binary outcomes, what we see is a wide range of adjustment levers that allow companies to stabilize and evolve, which materially reduces downside risk for senior lenders like ourselves.
Great, thanks, Caitlin. Just so people know we're aware of the echo, so we're working on that. Hopefully that'll clear it up. But maybe for both of you, if you could talk a little bit about how your platforms are approaching now new software opportunities today. I think we've heard a lot from some maybe wanting to kind of maybe take them down from here, but at the same time, sometimes disruption obviously leads to some opportunities in the space too. So are there any sensitivities around maintaining or reducing overall software exposure at your platforms? And what are some of the must-haves when considering any new software investment? So Seth, do you want to start?
We're not reducing our software exposure broadly. So we believe in a lot of the themes that Caitlin just outlined. And we do feel that this is an overreaction to a very important topic, but we're being very highly selective. The market is applying a broad discount to software, but we believe that discount is misapplied to companies with structural defenses. And to your question, what are we looking for? We look for software businesses with differentiated data access, integrated distribution, and/or specialized and mission-critical workflows. So, for instance, on the data differentiated access, LLMs can only reason with information that they can access. Companies with proprietary data, exclusive content licenses, or unique infrastructure are structurally harder to displace. In integrated distribution, deep integration into daily workflows creates high switching costs. These companies can build their own AI tools because their users are already conditioned to their interface. And then finally, on the specialized and mission critical workflows, regulation, risk aversion, and deterministic requirements make certain workflows unsuitable for LLMs, which peak at 85 to 90% accuracy. So those are kind of the areas that we're sticking with, going to, and that's been part of our core underwriting thesis for quite a while now.
For us at Blue Owl, similar to what Seth is saying, we're not approaching software with a top-down mandate to increase or reduce exposure. We're just being highly selective at the individual credit level, which we've always been since inception. And so the must-haves for software names for us today are recurring mission-critical solutions with durable moats, demonstrable pricing power, conservative leverage, and sponsors with both capital and operational capabilities. We emphasize systems of record that are deeply embedded in the customer's workflows. They carry high switching costs and operate in environments where errors, downtime, or security breaches just can't be tolerated. So in these companies, AI is serving as an additive layer rather than as a replacement. And we believe that the most resilient winners will be the incumbents who successfully integrate these capabilities to solve complex enterprise-grade challenges, thereby increasing switching costs and solidifying their status as essential corporate infrastructure. So if these criteria are met, we are very comfortable leaning in, and if not, we're willing to pass sort of regardless of sector allocation targets. We've spent a lot of time underwriting technology risk, including how AI could disrupt or candidly enhance the business model. So underwriting AI risk has been a part of our process for the better part of the last 3 years. This is not something we've woken up to in the last 3 months in the same way the broader market seems to have. However, given how quickly technology is evolving, we proactively revisited our core thesis and reevaluated our portfolio with a forward-looking lens. And our analysis confirms the quality of our assets and gives us confidence that our portfolio remains aligned with where we believe the broader market's going. The challenge, I think, with AI and current large language models is that while it's world-class at communicating, at its core, it's a statistical engine designed to be predictive, which is excellent for a personal assistant, but it is a problem for systems that need to be precisely accurate. So payroll calculation, bank transfer, it's either 100% correct or it's failed. And in the corporate world, our tech president and PM of our tech business, Eric Bissonette, he said this on the last earnings call. He said, almost right is completely wrong for these businesses. And so these are the types of software companies that we've always sought to lend to. We have a 40-person underwriting team that's dedicated just to software. We think we have one of the market leading teams on the street. We're organized in similar to some of the sectors that Seth mentioned, subsectors like cybersecurity, healthcare, IT, fintech. So we have deep domain coverage and expertise. We've got 20 billion of AUM in our two technology-focused BDCs. And so we think for the right credits, our capital is going to become more valuable to some of these better, portfolio companies in the near term. And we want to be one of the more sophisticated partners to our clients to help them navigate the AI transition.
Super helpful. Thank you. And just as a note to everyone too, we do have a Q&A function. So definitely feel free to enter any of your questions and we'll get to those when we can as well. So Seth, maybe back over to you. I mean, we know that a lot of the BDCs use independent third-party valuation firms as part of their quarterly kind of process. Can you talk about how movement in spreads and multiples for the liquid software names can impact valuation of software investments in your portfolio? Could we see more meaningful unrealized appreciation in the coming quarters if liquid software names remain pressured?
Yeah, absolutely. So first, let me level set on and explain the valuation process, because I think there's been a lot of misunderstanding in the media and things of that nature. So we're 115 employees at Hercules Capital. We're very small compared to Blue Owl, but with our size, we're mighty. And we use about half of the team is the deal team. So specialists, just like Caitlin outlined, specialists in their domain of expertise, either life science or tech. That deal team is responsible for re-underwriting each portfolio company on a quarterly basis. That results in a quarterly review memorandum. The deal teams are responsible for sourcing, negotiating, binding, and managing each investment from inception to repayment. So cradle to grave, as we say. So they don't get to originate it and pass it off. So there is a complete re-underwriting process that takes place. Each portfolio company quarterly file is then reviewed by the credit teams for submission to IC to determine the credit rating and impact to the discount factor used for the debt positions. And I emphasize the debt positions because that's 95% of our portfolio, even on an AUM basis. The movements in the publicly traded software debt comps, which are highly liquid compared to our very illiquid portfolio, and credit spreads are used in our valuation marks as well. Because our debt investments are floating with floors, declines in the prime rate actually benefit our valuations. And that's something that's also a little bit misunderstood, is how could things in a volatile environment be kind of level? There's offsetting factors that takes place. But near term, we may see some unrealized appreciation in the software sector if more liquid comps remain pressured, and they are quarter to date. So if we had to do something today, we would say yes. There definitely will be marks associated with that. That would be a mark-to-market accounting effect, not necessarily a credit event. Also something that's been misunderstood. Just because we mark down what we think a third party would buy it for under ASC 820 does not mean that it's a credit event. And the key distinction is whether the borrower's underlying business performance is deteriorating, and we're not materially seeing that in our portfolio today.
Yeah, and that's a great point, because obviously during the pandemic in the first quarter of 2020, we saw meaningful unrealized appreciation across the sector, which had largely reversed 2 to 3 quarters later. So definitely not necessarily reality or a reflection of actual losses. So appreciate that description. Caitlin, maybe back over to you. We've observed widening of BDC spreads, decline in BDC stock prices, and also so elevated redemptions in some of the perpetual vehicles. But portfolio credit metrics for the sector remain relatively benign. So Blue Owl Capital Corporation, I think net realized losses for 2025 about 1.2%, non-accrual is 1.4%, and then in tech, actually net realized gains of 30 basis points in the year and non-accruals of 30 basis points as well. So can you just talk a little bit about Blue Owl's outlook for credit and what macro factors could weigh more heavily on performance?
Yeah, I mean, that's the irony of it all, is despite all the market noise and sort of the media frenzy around the space, is credit for the vast majority of managers has been exceptionally strong. Look, we entered 2026 from a position of strength. Our performance across our BDCs, as you noted, remains really solid. In particular, our tech-focused BDCs, very low non-accruals, limited realized losses. And that's maintained even against a more volatile macro backdrop over the past, call it, quarter. That being said, we're not being complacent. We're still very closely monitoring macro factors such as growth moderation, a potential reversal in the direction of travel for interest rates, and valuation sensitivity in sponsor exit markets. So, but we think our portfolios are well positioned. They're very modestly levered. The vast majority of our BDCs are operating under their target leverage ranges. Documentation is strong. They're highly diversified portfolios. And we believe this provides meaningful insulation if conditions were to soften. And importantly, we've underwritten our investments assuming a more conservative exit environment, not a return to peak multiples. And part of that was sort of echoed in those low LTVs that we referenced earlier as well. All that being said, top and bottom line growth of our companies across the platform has been strong. It's accelerated over the past few quarters. Amendment requests are muted. The quality of deals coming to market have been excellent. And thanks to our scale, we have ample dry powder to selectively lean in on attractive opportunities, especially as we see the economics start trending more favorably due to broader market volatility. So we think we're well positioned. And I think this is the type of environment where private credit really shines when there's a hiccup in public market sentiment. And it's one of the key value propositions of the space. You know, the bank market or the public markets can open and shut pretty quickly. But private markets have remained consistently open and ready to deploy capital, sort of regardless of the broader macro environment. And that's been a real ability for us to gain market share from sponsors and even non-sponsors for deal flow.
So despite the headline pressures, Hercules stock is trading at a premium to net asset value, which is pretty unique. And it has historically traded at a meaningful premium. So we think obviously this could be a competitive advantage, particularly if we see an increase in M&A activity. I know it was a strong end to last year, a bit of a slow start to this year. But if we see M&A pick back up, certainly at a competitive advantage there. So can you talk about your expectations for growth in 2026 and how the firm's maintained its strong operating performance, even with variability in rates?
Yeah, and just to Caitlin's point, we enter this environment with a strong balance sheet, strong credit profile. 2025 was a record year across key metrics like 4 billion of commitments for Hercules Capital and gross fundings of 2.3 billion, which was a 26% year-on-year increase. Total investment income of over $500 million, up 8%, and net investment income at 340 million, up 5%. New debt and equity commitments reached 3.9 billion, up 46%. So, very strong momentum coming into this. And as I mentioned, very strong credit balance sheet metrics. This is especially relevant for the M&A environment. We had 15 M&A events in those. Unfamiliar with us, we have 127 portfolio companies. And just to match and echo Caitlin's credit comment, we have one on non-accrual as of year end. We had one IPO. IPOs are very infrequent exits in our portfolio historically over the past 21 years. So not a big deal for us. And 4 new M&A events in Q4 alone. And realization events recycle capital into new originations at present credit spreads, which are obviously a little bit elevated as the base rates come down. And as shared on our Q4 earnings call, Q1 continues to be strong momentum with well north of 1.4 billion in closed and pending commitments as of Q1, and so meaning mid-February when we announced those Q4 results. We generally expect M&A in our portfolio to continue to be robust in 2026, with significant strategic activity involving larger competitors acquiring smaller valuation distressed peers, which we view as a net positive for the business. But with that said, Hercules remains committed to discipline, credit, and underwriting, maintaining ample liquidity, which we just did a raise in February, really as the anxiety was setting in, but before the majority of the anxiety set in. Very prudent leverage, 1-to-1 over 2025. And we had promised to bring that up and probably will a little bit in 2026, but not above our communicated ceiling. And our expanding private credit facility. So we have a number of private funds that we manage under our wholly owned RAA. So we're able to spread out this risk as well. And all of these are principles which position Hercules to maintain its strong growth trajectory throughout 2026 and maximize shareholder returns.
All right, moving on to another very hot topic in the space is redemptions. So Caitlin, over to you here. We saw net flows remain pretty positive in fourth quarter across most of the perpetual vehicles, even with the uptick in redemption activity. In the first quarter, we're seeing already some net outflows from some of the folks that have reported already. While some have kind of stuck to the 5% cap, we've seen some variability in terms of, redemptions being met. And you all in one of your vehicles decided to meet redemptions that were a bit elevated in the fourth quarter. So can you just talk a little bit about the decision to fund the higher redemption at OTIC and how you'll evaluate redemption requests going forward?
Yeah, of course. So the decision around funding the higher level of redemptions at OTIC, which just for those unfamiliar, it's our technology-focused perpetual non-traded fund. We, when tender requests are coming in throughout the quarter, we get a daily report, so we could see that they were trending higher. Our board met and had a very deliberate discussion, kind of rooted around the long-term platform considerations about whether or not we would extend the and upsize the tender or not. Ultimately, they decided that given the fact that we could do so without compromising portfolio construction, leverage, or credit quality, and we had masses of liquidity, that it was important to demonstrate confidence both in the portfolio and in the structure. So we opted to accept the full, call it just over 15% of redemption requests in the fourth quarter. We were running well under our leverage target. So in the context of 0.7 to 0.75 times debt to equity versus our target, which is closer to a turn of leverage, we had north of 2.4 billion of liquidity. And so the decision made sense both for the exiting shareholders and those remaining, because they were now going to have the benefit of a portfolio which was closer to its target leverage and had a higher weighted average spread on the remaining assets of the portfolio. This was largely because we found ourselves in a very unique environment where we were able to monetize a sleeve of our liquid assets above par to satisfy the tender request, which makes sense that they're lower yielding relative to our private assets. I think the market should hopefully read that as it was very unique and specific to that vehicle. It was one of the first elevated tender requests that the space had seen. And so we felt that we were in a position, both exiting shareholders and remaining shareholders would be better off, and it was the right thing to do. Going forward, though, redemption requests will continue to be evaluated through a very disciplined framework. Available liquidity, pro forma leverage implications, market conditions, portfolio impacts, and fairness to investors. And I think that part is often lost on the market. It's a board level decision, and it has to be, and they are fiduciaries to both the exiting shareholders and the shareholders that are remaining, and they need to take both groups, into consideration. And so we're going to remain pragmatic and thoughtful in the approach. Our Q1 tenders close at the end of the month next week. So we're in the cycle. We're a little bit behind some of the peers that have already reported. But the peers that have reported, the vast majority have seen higher redemption requests, and most, or I would say more than half, are holding the line at the 5% quarterly liquidity. Personally, Caitlin, I'm not speaking on behalf of Blue Owl now, I'm just myself. I think it's a good development in the market. And I think it allows for the recalibration of expectations around the liquidity mechanism of these funds.
Yeah, so you've a rating agency. I think when we kind of started to rate some of these perpetual vehicles in particular, I think the 5% cap or limit gave us a lot of comfort in how liquidity would be managed in some of these vehicles. So I think it is, in terms of some that are maybe like a bit of a rounding error, okay. But I think, seeing some of them hold the line at 5%, I think is encouraging for sure.
Yeah.
I mean, we talked about software a little bit earlier, and I from our view, it looks like this is kind of a longer term story. I mean, there's not a ton of 2026 maturities in software portfolios across the space. So I guess the question is, what do you think relieves some of the pressure on redemptions for the perpetual vehicles?
I think it's just consistent, good performance, transparent communication, and, just further evidence that private credit can continue to generate attractive risk-adjusted current income. I think we're viewing it at Blue Owl as more cyclical than structural. So, if we were to see another couple quarters of solid performance, and I think having more platforms as they come out hold the line at the 5%, I think that should hopefully start to change the media narrative around what's happening in the space. What's interesting though is that these higher redemption requests are happening while credit is still performing exceptionally well. So thank goodness. So what I think that allows for is that investors who aren't comfortable with the structure to cycle out, it might take a few quarters for them to fully get out of the position. But what it should do is leave a more stable remaining investor base behind for those who are comfortable with the structure and who want to receive the illiquidity premium of the asset class. And so I think recalibration while credit performance is strong is not entirely a bad thing. And we got really used to, really robust inflows with almost no outflows. And I think some market participants, not everybody, but some probably forgot that there are structural limitations to liquidity as the trade-off for the higher spread product. And so I think it's also important to note, like, we are still raising incremental equity every month. So equity has not gone to zero. It's definitely more anemic growth than we got used to over the last few years. But interest in the asset class remains. The FA partner and the RIA channels that we partner with are still highly, highly supportive of the products. And we're seeing increased interest internationally as well via some feeder funds that we've set up in different pockets of the world. So it's good to see continued diversification there as well. And hopefully in the next couple quarters, some of this should offset.
Yeah, I think that when people see the elevated redemptions, sometimes it gets lost on them that there is still money flowing in, even though there's maybe a little bit more flowing out at present. So maybe just for both of you, and we can start with Seth. I think in our view at least, one of the benefits potentially of the elevated redemption activity today is maybe kind of a rebalancing of the supply and demand in the space. And so that maybe could benefit spreads and terms and conditions, if not now, maybe eventually. But just curious, for some of the newer deals that maybe you're evaluating today, have you seen any shift to the benefit of the lender? And if not yet, do you expect competitive dynamics to improve in the sector?
Yeah, sure. So just as a reminder, equity market volatility is a tailwind for us on the demand side. We compete with equity. A lot of people think we compete with each other, but in order for Caitlin or Blue Owl and Hercules to have demand, the equity markets need to be a little bit unconstructive. So the converse would be like in 2021, where equity was just widely available. Tough market for us to compete. So it's a tailwind for us already. Periods of volatility, they prompt high quality companies, those who historically wouldn't even answer the phone if we called them for a needed debt, to proactively strengthen their balance sheets. So this is very good. These are high quality companies that have lots of remaining months of liquidity, that have historically relied only on equity, that are now picking up the phone. And that's beneficial to across the ecosystem, but also for Hercules Capital. And we're seeing that now. Our pipeline is robust, both in the quantity, obviously, and the quality. The BDC redemptions are beginning to rebalance the supply and demand, and so they do contribute into it. But just as a reminder, so everybody doesn't think that it's just about the question Caitlin just very eloquently answered. We've got the SaaS apocalypse. Can never say that word correctly. You've got the Iran war. You've got other market disruptions occurring that have really, caused this tailwind for us. It is not just the redemptions. And as capital exits of perpetual vehicles continue, it becomes a little bit less crowded field, providing Hercules modest pricing power that was suppressed during the peak capital inflow years like 2021. We're already seeing bifurcation in deal quality. Screens and passes remain at near record levels for us, and we're passing on more transactions than ever. I know that can fall on deaf ears, but you can appreciate the volume. It's just huge for our deal team now. But we're not, compromising on the quality dimension. So we'll continue to fill that pipeline and kind of triage the opportunities.
Yeah, I would echo a lot of the same themes. We're starting to see some early signs of rebalancing. It's definitely uneven. In certain pockets, we've seen spreads widen modestly. Documentation discussions, I think, are definitely becoming more constructive. But to Seth's point, the competition remains strong for high quality assets. And so I think the earlier signs of improvement are around structure and covenants and lender protections, which we think is just as, if not more important than headline pricing, because obviously market pricing will drift up and drift down, but you need a tight document in order to have good credit performance over the long term. And so we think if redemption activity and a lot of the macro headwinds that Seth mentioned persist, we would expect the competitive dynamics to continue moving incrementally in favor of the lenders.
I guess that's a good outcome, potentially a silver lining, maybe to some extent. So I guess, Seth, just lastly for you in the 3 minutes that we have left, PIK, another hot topic in this space that we want to just touch on. We've seen it obviously increase significantly since the COVID pandemic. We saw a lot of management teams give a little bit more detail about it. Their PIK exposure, and Hercules in particular said 86% of their PIK is related to structured at origination and not amendment related. But we've seen a lot of PIK kind of accumulate over time, over the last couple of years in particular. So how should we think about just PIK repayment activity? What does it take to kind of start seeing some more meaningful repayments? And is it something that investors should be concerned about at all?
It's a credit issue for sure. But there is good and bad PIK, and the distinction matters enormously. So good PIK structured into the original underwriting at the deal inception, reflecting a deliberate capital structure by choice of the borrower and an agreement with the lender, often to preserve cash flow, remaining months of liquidity. It's priced accordingly, and it's a feature, not a flag. In these scenarios, we allow companies to pick a portion of their interest, not the full amount. This is typically 1% of an interest cost of 11, 12% that we're talking about. And 80%, 86%, like you said, of our portfolio Q4 PIK falls into that category. And I would also note that 91% of all PIK was derived of our credit rated 1, 2, and 3s, our highest quality credits as of year end. Bad PIK is an amendment driven where the borrower switches to PIK because they cannot service the interest. That is a credit signal. That is concerning. And we have limited amendment related PIK by design. Payoff timing is a function of the exit activity. So those unfamiliar, our average duration over the last 21 years has been 18 to 24 months, even though contractually our loans are 3 to 7 years in duration. A lot of this PIK came up in very recent years. So it's not a mystery that it hasn't paid off because the loans haven't paid off. So PIK accrues until refinancing, M&A, IPO, and with 15 M&A events in 2025 and improving market exits, we're expecting to see PIK paid off at resolution. And even in 2026, we've already had some PIK payoff. So it's just very orderly and very in line with our normal 18 to 24 month duration of our portfolio.
Well, I just want to thank Caitlin and Seth so much for joining us today, and for all of you as well for tuning in to listen. And we hope you enjoy the rest of the sessions.